Okay, let's tackle the final piece of this puzzle, and it's maybe the most confusing. Bond yields. Why are there so many different ways to measure the return on a bond?
Because each one is trying to answer a slightly different question. A bond can be bought at a discount or a premium. It can be called early. It can be held to the end. One single number can't capture the return for all those scenarios.
The one you always hear about is yield to maturity, or YTM. What's that actually telling me?
YTM is the big one. It's the gold standard. It estimates the total return you'll get if you hold that bond all the way to its maturity date.
Hmm.
But there's a huge asterisk.
Uh-oh.
The calculation assumes that every single coupon payment you get is successfully reinvested at that same YTM rate.
So if the YTM is 5%, but rates drop and I can only reinvest my coupons at 3%, my actual return is going to be lower than the YTM I was quoted.
Precisely. That reinvestment assumption is key.
Yeah.
The calculation is complex, so people mostly just use financial calculators or software for it.
Okay, what about a simpler one? Current yield.
Current yield is great if all you care about is the income the bond is generating right now relative to its price.
Yeah.
You just take the annual coupon payment and divide it by the bond's current market price.
So you could compare that to a stock's dividend yield,
That's the perfect use for it. But it has a major weakness.
which is.
It completely ignores any capital gains or losses. If you bought a bond for $900 and you get $1,000 back at maturity, the current yield pretends that $100 gain doesn't exist.
I see. And then there's the simplest of all, nominal yield.
That's just the coupon rate. Annual coupon divided by par value. It's really just a reference point for calculating the other yields. It's not a true measure of your return unless you bought the bond for exactly its par value.
And finally, two for special situations, yield to call and realized yield.
Right. Yield to call, or YTC, is critical for callable bonds.
Mm.
It calculates your return if the bond gets called on a specific date instead of held to maturity. It helps you see if that higher coupon is worth prepayment risk.
And realized yield.
That's an estimate. You need it if you plan to sell the bond before it matures. You have to project what the bond's price might be on the day you plan to sell it.
Before we wrap up, I want to quickly touch on two other bond structures. First, the very popular zero coupon bond.
Zeros are super straightforward. They pay no periodic coupons at all.
So where's the return?
You buy it at a deep discount to its face value. The difference between what you paid and the full par value you get back at maturity is your interest. It's all calculated in. People like them because there's no reinvestment risk to worry about.
And the second one is a hybrid, the convertible bond.
Right. It starts life as a normal bond, paying interest. But it has an option built in that lets you, the holder, convert the bond into a certain number of shares of the company's stock.
So you get the stability of a bond, but the potential upside of a stock if the company does really well.
That's the appeal. You get the best of both worlds, in theory.